Hi there, everyone. Welcome to Chart This with Dave Keller. It is Friday, February 14th. Happy Valentine's Day. Coming to you from a kind of wet, still kind of snowy Redmond, Washington. Hope you guys are all doing well. Happy long holiday weekend here with Valentine's Day on Friday, with President's Day on Monday. Markets will be closed as a friendly reminder, and we will not be having an episode of Chart This as a result. It's also my son Henry's 9th birthday on Saturday, so that's very exciting as well. But hope you guys are all doing well, hanging in there. As we talked about on Thursday's show, what's the playbook for the Friday of a long holiday weekend? And the answer that I shared was kind of choppy, maybe sideways, a little bit higher on lighter volume. And as we look at the market conditions here going into the close, which is when we're recording this, kind of choppy, a little bit higher and lighter volume, or kind of half normal volume, it looks like, for this point in the day. So overall, kind of following the pre 3-day weekend playbook just fine. You don't expect much movement on a day like today, to be honest with you. Next week, after Monday's break, is when we'll expect to start to get a little more details on what's going on. So, what happens today, right? What are the key takeaways? I mean, I would say overall, right, when you're looking at the S&P 500, just as a quick market recap here, yesterday on Thursday, we closed above 6,100 for, really only the second time. Last time was back in third week in January. Today, basically not really a change from there. So I would say, do you count this as a big follow through day, signifying a bunch of bullishness after yesterday's breakout? I probably wouldn't. I'd wait to see what happens on Tuesday's session to see if we get some upside confirmation, but certainly not selling off or anything after yesterday's breakout. So overall, I mean, the long-term trend in the S&P, obviously pretty resilient. We are at new all-time highs as of this moment, and so overall that's pretty constructive. The end of the day, it's just how much further upside we can reasonably expect. The challenge I have with this market is that I don't see a lot of stocks pushing to aggressive upsides. They are out there, right? Like Meta, like Visa, like JP Morgan, random names in random sectors, technology names we've highlighted, Palantir kind of stocks, in nice uptrends. But there are also a lot of stocks that have pulled back quite a bit and have certainly changed from an uptrend phase to more of a consolidation phase. So while there are still names working, I would say the general takeaway I have is less ideal, less bullish now than it was, sort of late November, right? Even though the S&P is slightly higher, I would say the conditions now versus 2-3 months ago, very different, and not in bullish ways. I think you're getting a lot of signs of a bull market in the exhaustion phase, kind of nearing the end. And while we haven't had a significant breakdown, I would just need to see an improvement in indicators of breadth and performance of a lot of individual names to suggest a resumption of this uptrend in any meaningful way. Looking quickly at the market carpet, I would say, if you look at the biggest names here, the big growth names, NVIDIA getting back up to around 140, up almost 3% today, back into the midpoint of that range from Q4, I think is pretty bullish, to be honest with you, for NVIDIA. I think while we still have plenty of overhead resistance, same comment with the S&P holds here. Good that we're rotating higher, but not enough. I think NVIDIA needs to get above 150 in a significant way to really change that from a consolidating chart to more of a primary uptrend. But that's a problem. And one quick note: Applied Materials in that same group down 8.5% today, which isn't great. Apple pushing above 240. That's kind of getting out of that consolidation that we set, sort of mid-January to mid-February. That looks like Apple's making an attempt to regain or at least retest the December peak. That's encouraging. Meta continuing on another 1.25%, making a new all-time high again today. This is a stock that's been in a consistent uptrend. And, I would say Meta is an outlier in the fact that it looks like things are just long and strong up and to the right. The average chart does not look like that anymore. And besides those three FANG names that I mentioned that are having a decent day today, everything else in the Magnificent Seven are down today. So I think that tells you a lot. And if you look across the market carpet, I'm seeing very much a mottled, some green, some red, a lot of neutral. Now, again, this is one day. So, I mean, today is sort of a choppy sideways day anyways. But I would say, in the weeks to come, I would need to see a much more significant improvement in a lot of different individual equity charts. That would be reflected certainly in breadth indicators most readily available, I would say, to validate that. And if and only if you see that resumption of a bullish phase in some of those, would I be more optimistic than I am right now. All right. Point of today's episode is to do a mailbag. We've had some great questions this week. I grabbed 5 or 6 of them, it looks like, to answer today. And again, these all came from people like you watching the show, throwing comments either during the live broadcast or posting it on our YouTube channel in the comments section. Either one's fine with me, and I welcome your questions at any time. Again, it helps me to just think about where I should focus more, and really helps me appreciate where you guys are coming from. All right, question number 1. Dave, which one is better, MACD or PPO, to keep watch for a pullback and a potential entry point for individual stocks? Thanks so much for the question on there. You know, I often will get asked about MACD and PPO and the differences between them. We'll use JP Morgan as an example here. And I'm just going to add these 2 indicators to the chart just so you can compare them. And what you'll probably notice is these indicators are incredibly similar, right? I mean, if you look, there are subtle differences just because of the calculation, because MACD in the top is calculated based on dollar values. The PPO, which stands for percent price oscillator, basically does the exact same calculation, but it uses percentages instead of dollars. So the MACD, moving average convergence divergence, is driven by the difference between 2 exponential moving averages. And the most common calculation is the 12-day exponential average minus the 26-day exponential average. And that's what the black line represents. The red line is called the signal line. Common technique in the technical analysis or technical indicators is that you have the main indicator and then you lag, you smooth that out with a moving average to create a signal line, right? To have a little lagged version of that initial assessment. And you look at when we cross above and below. A number of indicators like stochastics and others have that same kind of idea where you have a main comparison that you're making. Then you smooth that out with the moving average, and then you look at when the 2 cross one another. So this is doing the dollar difference between the 12 and 26-day exponential averages. This is using the percent difference between the 2. And so, it's very, very similar. The only time you see big differences is if stocks have had significant gains or losses in value, because the dollar values will mean very different percentage movements depending on the volatility of the stock. I would say the PPO generally is a better indicator to use, just because you don't have to worry about inconsistencies when you're comparing different stocks, right? So the values kind of have a meaning. The value for MACD is kind of meaningless because it's a dollar value, and if the stock's trading at $200 a share or $2 a share, the values of the MACD are going to be dramatically different. It doesn't really mean a whole lot. With the PPO, it's actually based on percentages. So while different stocks have different percentage moves on average, it is a little more of an apples to apples comparison. So I've just learned to use PPO. Although I first learned MACD and used it for years, when I dug into the details behind it, PPO just seems like a better option. So I don't know if one or the other is better, particularly for identifying pullbacks and potential entry points, which is the point of your question. I would say either one is fine. And just given the fact that they're both fine, I would use the PPO because it's just a more flexible, more, it facilitates a better use of the indicator for comparisons and things like that. So I think it's a better indicator to kind of spend your time with. If you're trying to identify pullbacks, I mean, remember that both of these are kind of doing the same thing. I mean, both of these are, looking with a chart like JP Morgan. This is a good example just because it's in a pretty good run. So it's had a bunch of these viable pullbacks. You look for when the MACD or the PPO pull back, and then when it gives the buy signal, that's a confirmation that it's now going higher. If you are trying to identify, price swings, I would say better than the traditional signals, which are the MACD indicator crossing up through the signal, I would be looking at the histogram, because when a stock is selling off, like here, you see the histogram is going much, much lower because the MACD line is getting further from the signal line. But as the bottom is happening and we start to turn higher, the histogram will change from going down to going up. And that's usually what is better at pinpointing the actual low, right? And you can see it on a bunch of these times where the histogram comes down. When it just starts to turn up, that's kind of probably more your entry point. that you're looking for. And it's not perfect, right? So there will be times when you get a bit of a false positive, but overall, it's a pretty good way to think about it. So I would be waiting less for the traditional buy signals, which will often come well after the low. I would be looking for the histogram to turn back and stop going down. That is often, a good indication of a swing. And if that's not helping you as much, I would say look at an hourly time frame, look at a 5-minute time frame, look at an intraday time frame. Depending on how the stock tends to trade, depending on what kind of swings you're looking for, shorter time frame might be more helpful there. You also can change the settings of the MACD or PPO indicators. I feel like that's a rabbit hole of things, but that's another sort of lever you can pull, is make the indicator more or less sensitive, which, if it feels like you're always way too late on the swings, make the indicator use smaller day counts. That makes it more sensitive, and it's going to be a little noisier. It's all about what's going to help you identify those swings on the charts that you're looking at. Great question. That was actually a good one that made me think quite a bit. So thanks for that. All right, next question. You often use the term secular appreciation. What do you mean? How are you defining secular in the context of investments? Yeah, phrases like secular and cyclical get thrown around. Same as like short-term and long-term. And those phrases may mean something very different for me than for you. And I totally get it. I will tell you kind of the general way that I think of timeframes. And for me, my market trend model is a pretty good way to kind of illustrate this. I kind of think of the market on 3 timeframes. This is a weekly chart of the S&P featuring my market trend model, which is just using a series of exponential moving averages, actually using the PPO indicator to chart the difference between those moving averages. The short-term trend, or what I call the tactical trend, a couple days to a couple weeks. I would say the medium-term trend, a couple months or so. Long-term trend, a couple years. So that's the secular trend, couple years. Here's the medium-term trend, or the cyclical trend, I would say a couple months. And then the short-term trend, or the swing trading trend, what I call the tactical time frame, a couple weeks. So secular, couple years, cyclical, couple months, tactical, couple weeks. That's kind of how I think about it. You can tell those are not hard. In fact, it's not like it is a 6-month time frame, because I don't think the markets are that consistent and that systematically moving. I think there's a little more wiggle room. So I try to generalize a little bit. But when I use a phrase like secular, I'm talking about over a year, multiple years, those kind of time frames. And I think the reason why this market trend model resonated so much with me over the years is because it really shows how there are multiple time frames at work. A lot of times I find people see a reversal, and it's a short-term, like tactical reversal. So you should be concluding, all right, that's a tactical upswing. But a lot of people make conclusions on, okay, that's the bottom, and now we're in a secular bull market. And in my head, I'm thinking, that's a short-term signal on a short-term chart. You have no ability to forecast a year plus down the road by that short-term little thing. So remember, short-term decisions with short-term data make long-term decisions with long-term data. So when you have a buy signal or a sell signal, when you get a signal from PPO or moving averages or RSI or any of these, keep in mind these different timeframes and just reflect on, is this a short-term, I should be swing trading this thing type of signal, or is this a long-term, I should be rotating my retirement account more into energy stocks, because we're getting a big secular shift that's changing more of the long-term timeframes. I find often with people using charts and technical analysis, there is a big mismatch between the time frame of their chart, the time frame of their indicators, and the time frame of their portfolio, right? Their investment horizon. So I think that's an area, I know from working with a lot of investors over the years, that's an area where you probably could stand to improve. And again, I often get people, the most common mistake I see people make is drawing long-term conclusions from short-term signals or short-term data. So if you're trying to make big long-term thoughts about things, look at weekly charts and monthly charts. That's how you want to kind of think. Great question, by the way, and I hope that discussion of timeframes helps you out. For SMCI, super microcomputer, the previous ceiling becomes the current floor. Is 40 the new floor? Thanks for asking about SMCI. This came up. I showed this on the show at some point, and yep, and I remember this, and we talked about the this kind of inverted head and shoulders pattern that we're seeing here. the question that you asked, the previous ceiling becomes the current floor. And we thought that's a technical concept called polarity, where a level of resistance is broken and that resistance now becomes support. Same thing, support is broken, that often becomes resistance on the way back up. So that is a well documented phenomenon that happens with price action. I would argue that's a phenomenon of what are related to what's called anchoring or priming, where the price level has meaning and the markets have a memory because investors see a certain price level and they remember those swings, and as a result, orders will tend to gravitate around those points. I think that's kind of what's going on. So your question was, is 40 kind of the new floor? I probably would think of it less that way, only because I'm seeing this as an inverted head and shoulders bottom, or what's called a Buddha bottom, if you really want to know the way that people refer to these. So that's kind of how you would chart it, right? You have a low surrounded by higher lows. It's not perfectly symmetrical, but good enough, I think, for what we're talking about. The neckline is formed by the swing highs between the head and the left shoulder and between the head and the right shoulder. So you connect those 2 points, you draw a trend line. When we finally break through that line, that completes this inverted head and shoulders pattern and suggests further upside from there. So I would think of that neckline as the new support, right? So that's the resistance that's now broken. That becomes support. So you certainly, after a breakout like this, you want to see additional follow through. You definitely want to see that level hold. The reason why that could be important here is a lot of times things will stall out at the 200-day moving average. You want to make sure if we do roll over after that, we kind of hold that level, because if not, all of a sudden it starts to look a lot less like a good valid breakout of that inverted head and shoulders pattern, and maybe something different. If there was not a clear inverted head and shoulders pattern, some kind of price pattern, yeah, I would just use the price levels that you mentioned. And in that case, I'd probably look at the swing high here from December, which is around 47, 48. I'd probably suggest that as the peak to watch for. But again, given the particular layout of this chart that I'm showing you, that you asked about, I think that's the neckline is where I would personally think of it. All right, great questions so far. We're about halfway through. We've got 3 more to answer for you, but I do want to mention a couple things. Number one, here, let me go back. As a reminder, right, if you want to learn more about these techniques that we're using, and again, I appreciate all the kind words. I've gotten a lot of great feedback from some of you over time as we've done a market recap show, and now, we're about 4 or 5 months into the new show called Chart This. I appreciate so much you guys supporting me and following my work, and I'm glad if it's helped you in some small way make sense of these markets. I'm thankful very much for that. Hopefully you can pick up on the fact that I very much enjoy doing the show. I enjoy answering questions. I enjoy talking about the markets, and I hope that helps you make sense of things. If you want to learn more, if you want to upgrade your own use of technical analysis, I mean, the real goal of what I do is to help investors make better decisions. I used to do that with big money managers and institutional investors. That was great for a while. Now I'm finding it's much more fulfilling to help financial advisors, to help individual investors, to help people really trying to make a difference in their financial lives, to use these tools, these powerful tools and techniques to make better decisions. And if you want help doing so, you can go to marketmisbehavior.com and then click on Become a Member. In the upper right corner, this will tell you about what's called our premium memberships. 3 main benefits that are listed out here. Number one, virtual courses, what we call our flight school. We're actually in the process of creating a new course called Flight School Technical Indicators, where we'll go through indicators like MACD, PPO, and a bunch of other ones, kind of share with you how to use it, what signals to look for, some examples to kind of help you improve your use of different indicators. But we do have already some virtual courses that will help you understand technical concepts, behavioral finance, and behavioral biases, etc. We also have members-only reports like our weekly flight plan. That's our main investment-oriented report that we put out every weekend, and our monthly chart review where we apply our proprietary market trend model to a bunch of different charts, a bunch of different ETFs, and talk about themes and changes in those themes. Finally, you have access to a members-only community. It's actually been really fun growing a community of like-minded investors. It's become a very active place to talk about the market conditions every day. I'm in there answering questions from premium members about different charts, about reallocating assets, about managing risk, about stop losses, everything in between. So if this mailbag kind of discussion makes sense, here you'd have the opportunity to ask questions like that at any time, and all questions are answered that as soon as I can. But I'm in there every day. And some of my other premium members may throw some insights and opinions as well. So if you want more information, go to marketmisbehavior.com, click on Become a Member. Don't forget to use the code YouTube when you check out for a special deal on your first 12 months on any plan. Also, as a reminder, next week, no show on Monday, and I will be traveling down to Las Vegas. I'll be speaking at the Las Vegas Money Show on Tuesday and Wednesday of next week, and then coming back Wednesday night. We are planning to do an episode of Chart This on those days. I might have to tweak the timing of the show to accommodate some of these interviews that I'll be doing. But as you can see, if you go to marketmisbehavior.com/moneyshow, you can see my schedule. I'm doing a series of podcast interviews. Keith Fitzgerald, Jordan Kimmel, Lindsay Bell, Christina Hooper. I'll be sitting down with each of them to get some insights and from an investment color. And I'll be doing a presentation on Wednesday, 11 a.m. Pacific, called The 4 Deadly Sins for Investors. You can sign up for the Money Show right there. If you are going to attend the Money Show, if you sign up there, if you've already signed up, please make sure you say hello. Just grab me after one of those podcast interviews or come to my presentation on Wednesday. Always a pleasure to meet you guys in person. And I appreciate you so much coming and checking me out at the Money Show. All right. Let's continue on here with the mailbag episode. What do you make of today's candle for SN? This actually came yesterday during the broadcast. I did not have time to get to it. And let's take a look. Shark Ninja is SN. Here we go. From Consumer Discretionary. Let's look at a candle chart. What do I make of today's candle? So this is yesterday that you're talking about. This one right here. So here's the thing. I mean, it's not much. I mean, technically, you probably could call this. I don't even know if I would kind of call this anything because it's not a great example, and I'll tell you why. You can't really call it like a hammer candle or what's called a hanging man candle. That's when the open and close are near the top, and you have a long lower shadow and very little upper shadow. Here you actually have kind of a decent upper shadow. You have a big lower shadow. The size of the real body, which is the difference between open and close, is pretty big relative to the overall size of the range, or what's called the stem of the candle. I don't know if I would assign that. If there was very little upper shadow, and if this open close range, the real body was a little smaller, I might call that like a hanging man candle, which is during an uptrend. You have the open and close near the highs and a long lower shadow. Given that it's not perfect, I probably wouldn't. I wouldn't call that a candle pattern. That's kind of a weird one. That's a bit of a judgment call. I would say sometimes, things look very clear. Sometimes candles are very clear in terms of their construction. I don't know if I would describe this one as such. If I did call it anything, I'd probably call it a hanging man candle, which is when you have the open and close near the highs, a long lower shadow, limited upper shadow during an uptrend. And that's what it would be. Again, just because the dimensions are kind of a little off, a little abnormal, I probably wouldn't call it a valid candle pattern, to be honest with you. So I don't know. But again, I mean, that's the thing. Candle charts are one piece of the puzzle. And what I love about candle charts is that you use them along with what's called like Western technical analysis, right? Kind of traditional technical analysis tools. Candlesticks were actually predated everything else you see on the chart. They actually, were first created and first used in the 1600s. A rice market in Japan. They've got documented examples of where they did a kind of a primitive version or early version of candlestick charts for rice traders to think about buying and selling rice at the market there. And when I went to a conference in Tokyo years ago, a Japanese technical analyst, one of the members of the local association there, had a really cool presentation about the rice traders and how they used technical analysis. So it's funny. Some of the technical tools we use now are hundreds of years old, it turns out, and some of the other techniques arguably are even further back. You could trace their origins. But again, I think what's great about candle charts is they are part of the picture, but you use it along with moving averages and RSI and relative strength and whatever else you want to use. So for me, the specific label of the candle pattern less meaningful. Instead, I would say the most important thing here is the fact that the 50-day moving average held, and when it doesn't hold, that's when I would be concerned of that particular chart. Great question. All right. If inflation is still high, how is that going to impact consumer staples? Or is there any correlation between the two? That is an interesting question. A couple layers to that one. I will tell you, Ben Emmond, I interviewed him yesterday. I've not gotten that episode out. Hopefully later today, and if not, maybe tomorrow I'll get it out. I'm apologize, I haven't been able to do that yet. But we did talk about inflation quite a bit. So if that's something that's of interest to you, and I can't imagine it wouldn't be for most investors, I'd say you probably want to have a good sense of inflationary pressures right about now. But we talked about CPI, PPI, PCE, which is the Fed governor's kind of preferred measure of inflation. Talked about all of those related to one another, how it relates to interest rates, to consumer behavior, and so many other things. So keep an eye peeled for that. That episode of our podcast should be out here very, very soon. So what is the answer? So I would say this, right? I mean, I guess to flip it back to you, right? We're talking about consumer staples, right? Like beverages, alcohol, tobacco, soda and other beverages like Coke and Pepsi, personal goods, cleaning products, personal care products. Those are all kind of consumer staples. What you have to remember about consumer staples is they really are generally thought of as immune to economic conditions. And here's the way to think about it, right? If inflation is a real big issue, right? And all of a sudden inflation goes from 3% a year to 5% a year, are you going to downgrade your purchase of toilet paper? Or are you not going to buy Pepsi because of the inflation is 2% higher? Like, probably not. Would you reconsider a big trip that's going to be super expensive? Would you reconsider a luxury purchase where you might have had to save money? Would you reconsider borrowing to buy some new car or something like that? Yeah, I could see inflation definitely impacting some of those decisions. And you certainly could see, all right, inflation's a huge problem. Everything's getting more expensive. I'm not going to get the amazing car. I'm going to get a pretty good car because that's what I can afford. But most people don't, stop smoking because it gets too expensive, unfortunately, right? I mean, things in consumer staples are they're things you need, right? And it's not where you tend to have a lot of flexibility, right? And people don't tend to downgrade, again, like it's like toilet paper. It's like, are you not going to buy like you're going to buy toilet paper? It doesn't matter. And we get the same brand regardless of what the prices are. Like you need it. And so I would not say consumer staples are generally considered, with some notable exceptions, right? I mean, things like, Costco is in consumer staples. Could I see people, because Costco is, there's some staples happening there, but it's a lot of discretionary. I mean, there's a lot of just random stuff at Costco, like new tires and TVs and stuff like that. So I don't know how staple-y that is. So, I mean, would those stocks, be impacted? For sure. But generally, when you compare consumer discretionary to consumer staples, consumer discretionary, right, where they're discretionary purchases, where you may or may not make the purchase, whether, based on whether it's a good time to do so, based on your personal situation, based on the conditions around you, that's where you would see or expect more sensitivity to inflation. You saw inflation data, kind of mixed results between CPI and PPI this week. If you would see inflation, kind of drift higher, that's sort of what the Fed has been able to do, is by, sort of using, changing policy, cutting rates. They've been able to bring inflation down and bring prices down. As a result, things are getting, basically the inflation's getting lower. Although, again, it still seems like inflation's pretty good, right? I mean, eggs are more expensive. A lot of things are more expensive, but generally the inflation readings using the CPI are coming down toward the target that the Fed's talked about 2% a year. If inflation would start to go back higher, that's where you could start to see it, impacting things like consumer discretionary, I would say, primarily. So that was a long-winded way of saying not a big relationship. And again, but I would look within consumer staples, certain areas for sure, right? Like Costco, Walmart. There are people, certainly, I mean, there's a lot of discretionary goods now that they've kind of done. You could argue, and at one point, big box retailers were much more in consumer discretionary. It's kind of spread between those two sectors, right? So Home Depot is in consumer discretionary. You could argue there's things you kind of need there. It's not all discretionary goods. Big department stores, big box retailers like Walmart and Costco are now bucketed under consumer staples. It wasn't always the way. There's actually have rotated between sectors too. So that's how I would think of it. All right, last question. You mentioned using the inverted head and shoulders to predict potential future upside. Here, the pattern is used to predict the future level, but does it also predict the timeline? That's actually a really interesting question. We can go back to that SMCI example. That's what we were talking about earlier. And we talked about this inverted head and shoulders pattern. And sorry, I would have saved it had I remembered we were going to come back to this. I remember thinking that earlier. I was like, oh, great. We could actually use that same chart, but I totally forgot. Sorry about that. All right. Here's the chart, excuse me, that we were talking about. We can see that, this is basically like a 6-month pattern. If you look from the beginning of when it starts to look like an inverted head and shoulders to where we're at today, about a 6-month time frame. And that's about average, right? I mean, 2 to 3 months is kind of the general thing that's in the back of my mind of, at least 2 to 3 months to be a valid head and shoulders pattern. If it's way less than that or way more than that, it's probably something different. But sort of that 3 to 6 month range is probably a good way to think about the average time frame of a head and shoulders pattern. The exact answer to your question is no. There's no time frame that's implied by this particular pattern. It's similar to Fibonacci retracements and the fact that there's no real time component besides the duration of the pattern, which is important, right? If you're looking at a 3-day movement, you're like, oh, that's a head and shoulder. Like, it's not a head and shoulders. That's something different on like a daily chart. That's not going to be it. But as long as it sort of fills that basic requirement of the appropriate duration for the pattern, it's not saying we're going to reach some objective by a certain point in time. There are other sort of techniques that are under the technical analysis umbrella that do look for that relationship between price and time. So giving a signal and suggesting we should get to this point around this date. And those two are Elliott Wave, which basically looks at the wave patterns, right? And Bob Prechter's made a decent career out of promoting Elliott Wave and teaching people how to do it and sharing ideas based on that, built on the work of AJ Frost and others who really and Elliott himself, who created it originally. But that is really looking at based on the movements over the last couple waves, you can project wave C should hit around here, around this time frame. And so it does look at a relationship between price and time. The other one that comes to mind is Gann analysis, which is less known and less used. But some like Connie Brown have written a lot of good work on that. Hema Reddy comes to mind, that's written a book on Gann that I thought was pretty well done. There are probably some others out there, and I'm not a big Gann person, but I used to work with a guy, Jim Smith, who had a firm called Catapult Research. He actually still might be going. I haven't talked to Jim in forever, and reminding me to reach out to him again. But he has spent his whole career, advising people based purely on Gann analysis. And what's interesting about it is it really looks at the triangulation between price action and time, right? The idea that W.D. Gann in the early 20th century, kind of in that Jesse Livermore kind of era, a little later, thought about the relationship, and then looking at patterns and thinking about how long they took and how far they should go, really applying more geographic or geometric shapes and dimensions to the chart. So if you're interested in that, you want to see what it's about, I would pick up books by Connie Brown, Hema Reddy. Those are the two to come. Gann Made Easy by someone whose name I forget, was the book that was originally recommended to me back in the day by Jim. And then Elliott Wave, Bob Prechter's books do a really good job talking about socionomics, which is actually a whole other dimension I think is really, really good because there's a very behavioral component to that, but also Elliott Wave. Last one on that, sorry for just throwing a bunch of books at you. Steve Poser wrote a book called Applying Elliott Wave Profitably, I believe is the name of the book. And that's probably one of the better books I've seen about the behavioral implications of Elliott Wave. I'm not a big Elliottian, right? You see, I don't talk a lot about, all right, this is a wave 3, and some, again, have a lot of success. It's just, I learned enough about it to know it. And I also learned enough about it to realize that's not how I like to think about things. But I would say that his book in particular talks about the behavioral implication, why wave 1 tends to look a certain way, why wave 3 tends to be the longest wave, why wave 5 can often become extended. I thought he did a really good job of describing sort of the behavioral reasons why the market can be interpreted to move in waves and what the different waves mean. That resonated very much with me, and thinking about investor psychology and behavioral biases. I thought that was brilliant. So fan of that. But other than that, those would be the two that really try to do it. And traditional price patterns like this usually don't project any sort of time frame. It's more about the price relationships. This was the height of the pattern. And as a result, this is the next price objective, no time assigned. That was it. Hey guys, those were some fantastic questions. I really appreciate. I can't tell you how much fun it is to, dig through the questions for the Friday episode and sort of see where we're going to go. And it's often taken us to a lot of different places. Hopefully, some good book recommendations and different insights about the markets and how you can improve your decision making. But I hope you enjoyed this particular episode of Chart This. Again, happy long weekend, happy Valentine's Day for those of you that celebrate. On Monday, markets are closed, and we will not have a live Chart This episode, but we'll be back on Tuesday and Wednesday from Las Vegas at the Money Show. Timing may be a little different. I'll try to keep you updated, but every day we'll certainly have a show to share some observations as the markets evolve. So have a fantastic weekend for Market Misbehavior. I'm Dave Keller, and remember, it's always a good time to own good charts. Take care, folks.